Welcome to this explainer, where we're going to take your foundational accounting knowledge and elevate it into true strategic insight. We're talking about things like trial balances, accruals, prepayments, and basic depreciation from your earlier notes. Today, we're taking those basics and forging them into the ultimate, real-world CFO toolkit. Look, stepping up to the CFO level is notoriously difficult for traditional accountants, and that's because it requires a massive mental leap. You have to move from simply balancing historical books to actually predicting and protecting the future of the entire organization. So we're going to connect the dots across advanced financial management, advanced performance management, and taxation to see how high-level finance truly operates.
So how exactly do you measure a business that hasn't even been built yet? It's a provocative question, right? Let's dive into it. Because shifting from basic, backward-looking accounting to high-level strategic finance means you absolutely must look at the future, not just the past. A true strategic leader doesn't just record day-to-day transactions. They evaluate massive, highly uncertain projects. They figure out how to price completely new products for optimal margin. They manage complex human behavior through performance metrics. And they aggressively protect hard-earned cash flows from taxation.
Here is our roadmap for today. We're going to cover 1. Advanced investment decisions, 2. Strategic cost management, 3. Measuring real performance, 4. Navigating corporate taxation, and finally, 5. Traps and final rules.
Section 1. Advanced investment decisions. Evaluating strategic projects. Let's see how we make those massive multi-million-pound choices.
Now, standard net present value, or NPV. It works fine for simple everyday projects, but it kind of blends everything together into one generic discount rate. In the real world, how you finance a project changes its value completely. That's where adjusted present value, or APV, comes in. APV goes beyond simple NPV by isolating the actual value of how a project is funded. It says, hey, let's first value the project as if it were entirely equity financed to see its pure inherent operating worth. Only then do we look at the specific financing side effects separately. This gives you a much clearer picture of where the value is actually coming from. To actually crack APV, whether you're in an exam or pitching to the board, you're going to follow 3 specific steps. Step 1. Find the base case NPV using an ungeared cost of equity. Basically, you're removing the financial risk of debt altogether to see the project's baseline viability. Step 2. Add the present value of the tax shield. Because debt interest is tax deductible, borrowing money actually creates this massive financial benefit that shields your operating profits from the taxman. And step 3, strip out the issue costs. Investment bankers always get their cut, right? Those underwriting fees are an immediate, unavoidable cash outflow that drags down your overall value.
So, here is your golden equation. Lock this into your memory for the boardroom and your AFM exam. APV equals the operating NPV, discounted at the ungeared cost of equity, plus the present value of the tax shield and any other financing effects, like subsidized government loans. Master this one line, and you master strategic investment appraisal.
Section 2. Strategic cost management. Pricing and producing for profit. Okay, so we valued the project, but how do we intelligently price the actual product and manage our margins?
Picture a factory. You're making a simple bicycle, and right next to it, a highly complex, custom electric dirt bike. Traditional methods just smear overheads across both products using a single rate, like labor hours. This drastically overcosts the simple bike and dangerously undercosts the complex one. Activity-based costing completely solves this. ABC assigns overheads using precise activity drivers. Think the number of specialized machine setups or rigorous quality inspections. This gives you a highly accurate cost profile, which is absolutely vital when modern overheads are huge and different products consume factory activities in vastly different ways.
But what if the market is just incredibly competitive and dictates your selling price? If you want to lock in your margins from day one, target costing flips the traditional script. Instead of lazily adding a markup to your production cost, you start with the market selling price. You subtract your required profit margin to find your absolute target cost. Then you look at your current estimated cost. If it's too high, you've got a cost gap. But you don't just accept it. You close that gap using value engineering before production even begins. This might mean swapping out an expensive titanium casing for cost-effective aluminum or completely renegotiating with your suppliers. You'll definitely want to memorize this fundamental difference in timing. Target costing happens extremely early. You're locking in 70 to 80% of a product's costs by actively designing them out during research and development. Kaizen costing, on the other hand, takes over later.
It happens right on the factory floor, driving continuous, incremental cost reductions day by day during active production.
Section 3. Measuring real performance. Tracking strategic success. So, the product is out there, but are we actually winning on a strategic level?
Because financials alone, they just aren't enough. If you only look at profit, a manager might gut R&D or slash customer service just to boost today's numbers, completely destroying the company's future value. The balanced scorecard solves this dangerous short-termism by linking cause and effect across 4 vital perspectives. Investment in learning and growth for your employees directly drives better internal business processes. Faster, higher-quality processes drive intense customer satisfaction. And finally, those highly satisfied repeat customers drive your ultimate financial success.
Now, when evaluating division managers, return on investment, ROI, is a really popular metric, but it carries a massive behavioral trap called sub-optimization. Imagine a successful division with a current ROI of 20%. A new project comes along offering 15%. Even if the company's overall cost of capital is only 10%, meaning the project absolutely adds real value to the firm, the manager will reject it. Why? Because that 15% drags down their personal 20% average. No way they'll accept that. Residual income beats ROI entirely because it measures absolute profit in pounds or dollars after deducting a capital charge. If ROI is positive, you take the project. It's that simple, and it aligns management behavior perfectly with shareholder value.
Look, nothing destroys manager morale faster than being judged on costs they literally can't control. This brings us to the golden rule of performance management, the controllability principle. It states you must never penalize a manager for centralized decisions. If head office arbitrarily apportions central rent or corporate marketing costs down to a local division, you must strictly exclude those from the division manager's performance evaluation. Evaluate them purely on what they can actually influence day to day.
Section 4. Navigating corporate taxation, compliance, and cash retention. Let's move to the final life cycle stage and see how we manage corporation tax.
These hard numbers from the TX notes are absolutely non-negotiable for the 2025 and 2026 syllabus. If your company profits are under £50,000, you pay the small profits rate of 19%. But watch out, because once your profits exceed £250,000, you're hit with a massive jump to the main rate of 25%. For profits sitting between those two figures, marginal relief is applied to smooth that hefty transition.
Now, in tax computations, normal accounting depreciation is totally disallowed. Why? Because different companies use wildly different depreciation policies, so HMRC standardizes it. Instead, they give you capital allowances. The absolute crucial point here for asset purchases is the annual investment allowance. The AIA lets you write off a massive £1 million of qualifying plant and machinery immediately against your taxable profits. This is a tremendous, unparalleled tool for cash flow when you're scaling operations.
To keep your corporate tax computations flawless, remember this strict divide. Revenue expenses incurred wholly and exclusively for the trade, like salaries and rent, are directly deductible. Capital purchases, however, must use capital allowances spearheaded by that powerful £1 million AIA.
Section 5. Traps and Final Rules. Avoiding real-world pitfalls. We're rounding out our CFO Toolkit with a strict look at the most common exam and boardroom traps.
A massive trap in variance analysis is reversing these exact definitions. A planning variance compares the original budget to a revised standard based on actual external market conditions, like an unexpected global material price hike. It is completely uncontrollable by the manager. The operational variance, however, compares that revised, realistic standard against actual performance on the factory floor. This is what the manager can actually control through efficiency, and it's the only variance they should ever be judged on.
When stepping into mergers and acquisitions and valuing a target company using the PE ratio, never, and I mean never, just grab historical earnings right off the income statement. You must always adjust for maintainable recurring profits. For example, if the target company sold off a massive warehouse last year for a huge one-time gain, you have to strip that out. You only want to value the true underlying recurring earning power of the business.
And when implementing activity-based costing, don't fall back into traditional, lazy habits. The entire point of ABC is precision. Defaulting to volume drivers like basic labor hours entirely defeats the purpose. You must rigorously identify specific activity cost drivers, like the exact number of machine setups or the number of purchase orders, to accurately assign those complex overheads.
Which brings us to the ultimate rule. For every single advanced exam, and honestly every major boardroom pitch you'll ever make, state your assumptions clearly, show all your workings, and link your calculations directly to strategic advice. Look, a spreadsheet full of pristine numbers means absolutely nothing if you can't explain the commercial why behind them to the CEO or the board.
As we wrap up this explainer, I want you to ask yourself, are you ready? Are you ready to take these high-yield frameworks, absolutely crush your ACCA exams, and step into true strategic leadership? From calculating precise project value with APV, to aggressively driving down costs with target costing, aligning long-term behavior with the balanced scorecard, and navigating corporation tax, you now hold the ultimate toolkit to build, measure, and protect corporate value. Keep reviewing these essential frameworks, apply them deeply to practice scenarios, and go claim that CFO title.